Imagine you're in a car on the Mumbai-Pune expressway. The finance minister is in the driver's seat, pressing the accelerator because elections are coming. The RBI governor is in the passenger seat, slamming imaginary brakes because inflation is racing. And in the back seat, whispering directions that neither of them can ignore, is a guy named Jerome Powell, who lives 12,000 kilometers away in Washington, D.C. This is not a joke. This is how India's economy is actually run. So here's a question. If no single person controls your EMI, your salary and your purchasing power, then who does? Most Indians have a simple mental model of who runs the economy, the government, right? The Prime Minister, the Finance Minister, they decide the budget, they announce the schemes, they cut taxes. End of story. But here's what is interesting. The model is about as accurate as saying the captain of a cricket team decides every single ball. The reality is messier, much messier. India's economy is controlled by three forces that are constantly pulling in different directions. First one, the finance ministry. Their job is growth, more jobs, more factories, more GDP. When they want the economy to speed up, they spend more and tax less. Simple. Force two, the Reserve Bank of India. They control monetary policy, interest rates, money supply, inflation. Their job is stability. It's very simple to understand. When prices are rising too fast, they raise interest rates. When growth is stalling, they cut them. Now here's a problem. Force 1 and Force 2 frequently want opposite things at the exact same time. The finance minister wants cheaper loans, so businesses expand and factories open. The RBI governor wants higher rates, so inflation doesn't eat your salary alive. One wants the accelerator, the other wants a brake, and that's before we even get to the Force 3. Let me give you a real example, and this one is genuinely wild. In 2018, the tension between the RBI and the government got so bad that the government actually invoked something called Section 7 of the RBI Act.
Government has invoked never before used powers under the RBI Act, allowing it to issue directions to the central bank governor on matters.
It's a nuclear option. It allows the government to issue written directions to the RBI governor. The RBI governor must then follow them. This provision had existed since 1935. No government had ever used it in 83 years. And then in 2018, someone in the finance ministry decided, you know what, today's the day. The RBI governor of the time, Urjit Patel, resigned shortly afterwards. This was not a coincidence. This was a man who looked at the situation and essentially said, if I can't do my job independently, I'm not doing it at all. And here's a critical context that most people miss. The fight wasn't ideological. It was about money. Specifically, the government wanted the RBI to transfer more of its surplus reserves to the government. Translation, give us your emergency savings so we can spend it on schemes before the election. The RBI's argument was those reserves are our buffer. If a global crisis hits, we need that cushion. The government's argument was the buffer is too big and people needs roads right now. The government won. The RBI transferred 1.76 lakh crore back to the government. Now let's try to flip the lens. Was the government entirely wrong? If you're a finance minister staring at an election cycle, you want money to build infrastructure and cut taxes. Growth now and problems later. That's a political calculation baked into democracy itself. The RBI's job is to be the adult in the room who says problems later are still problems. The tension is not a bug. It's a future. The RBI was deliberately designed to be independent, precisely so that politicians couldn't print money every time they needed votes. The friction is the point. But there is a twist in the story, and this is where it gets strategically fascinating and honestly a little absurd. Even when the RBI and the finance ministry agree on something which is rare enough, there's a third player that can override both of them. And this player doesn't answer to anyone in India. Meet the US Federal Reserve, the American Central Bank, Jerome Powell. That guy is in the backseat of your car. And here's how it works. When the Fed raises interest rates in Washington, global investors do something remarkably simple. They pull money out of emerging markets like India and park it in American bonds. Safer returns, less risk. The rupee falls. Imported goods, including the oil that runs your scooter and the cooking gas in your kitchen, becomes more expensive overnight. Remember my first video? Foreign investors pulled $1.68 trillion from India in 4 months? That was not Indian decision. That was global capital reacting to geopolitical risk. They move money at a speed and scale that makes Indian policymakers feel like they are trying to steer a ship with a spoon. So here's a logical question. If the Fed chairman in Washington can move the Indian rupee more decisively than the RBI governor in Mumbai, who's really in control? Let that sink for a moment. And then there is oil. India imports over 85% of its crude oil. When OPEC sneezes, India's current account deficit catches a cold. When the Strait of Hormuz gets blocked, your LPG cylinder gets more expensive. Not because anyone in Delhi decided it should, but because a geopolitical crisis 2,000 kilometers away ripples straight into your kitchen.
LPG control order, which requires consumers who have access to piped natural gas to surrender their LPG connection.
The finance ministry can budget all it wants. The RBI can set rates all it wants. Some forces are simply outside their control. And the thing is, everyone in the system knows it. Here's an uncomfortable answer, and it's the most important thing in this entire video. Nobody fully controls India's economy, and that's sort of the point. India's economy is not controlled, it is negotiated. Every interest rate decision, every budget announcement, every rupee fluctuation is a result of a three-way negotiation. It's a negotiation between a finance ministry that wants growth and votes, an RBI that wants stability and credibility, and global forces that don't care about either. The system is designed so that no single institution has absolute power, because absolute power over a $4 trillion economy in the hands of one person or one party is genuinely terrifying. The checks and balances are real. They are messy, they're frustrating, they sometimes look like dysfunctional, but they exist for a reason. And now here's where this stops being a civic lesson and starts being relevant to your actual life. Because this negotiation isn't abstract. It shows up in your bank account every single month. When the RBI raises the repo rate, your home loan EMI goes up. When the government increases spending without corresponding revenue, inflation rises, and your monthly grocery bill silently climbs up. When the Fed tightens and the rupee falls, your foreign vacation, your imported phone, even your child's education abroad all becomes more expensive, and you didn't even vote for any of it. But here's a part that nobody will tell you, and this is genuinely useful. Understanding who controls what gives you a massive personal advantage. If you know the RBI is likely to hold rates because inflation is sticky, you can lock in a fixed rate home loan before floating rates rise further. If you understand that the government's pre-election spending spree will push the inflation up, you can adjust your investments, shift some money into assets that historically beat inflation. If you see that the Fed is signaling rate hikes, you can anticipate the rupee weakening and plan your dollar-dominated expenses accordingly. This is not a financial advice, this is pattern recognition, and the patterns are surprisingly consistent once you know what to watch. So where does this leave us? Here's the paradox of the Indian economy in 2026. It is simultaneously one of the most managed and one of the most chaotic economic systems in the world. Managed because the RBI and the finance ministry are constantly intervening, tweaking and adjusting. Chaotic because global forces are constantly intervening right back, and they don't care about your 5-year plan. The question isn't who controls India's economy. The real question is, can you read the tug of war well enough to protect yourself, regardless of who is winning? We are a brand new channel, and we are trying to build a community here that actually understands the intersections of business and geopolitics. If you found value in this video, or if you have learned something new, please consider subscribing. And here's a question for you. Do you think RBI should be more independent from the government or more accountable to elected leaders who represent the people? Drop your take in the comments. I read every single one. Thanks for watching, and I'll see you in the next briefing.